Hi everyone, it's Andrew here. So this will be my last video on A2 Milk, and today I'll go through the management changes, the balance sheet, the valuation, and I'll even do a taste test as well since I have some A2 Milk formula right here. So please like and subscribe to the channel as it really helps me out. Also check out my e-magazine it's in the description with my market commentary, a watch list, and my updated intrinsic values for a long list of companies. Because $10 a month, and I aim to give far more value than $10 in each edition. Now, I've already talked about the industry and the competitive advantages in the previous videos, so please start with those so this video makes sense. Okay, so this is what I have noticed in the past 5 years at A2 Milk. Here is a bit of a timeline of events. We have in 2017, the CEO was Jeffrey Babbage. In 2018, they changed CEOs to Jane Hindlicke. In 2019, the CEO was still Jane Hindlicke. I think I'm getting that right. Anyway, in 2020, Jane Hindlicke was told to step down and Jeffrey Babbage came back as the interim CEO. Now, the things got messy here. Let me explain a little of what actually happened. Hindlicke claimed that she resigned as chief executive of the A2 Milk Company in December 2019 because her husband had cancer, which he did, and it's terrible. Adding that she didn't think A2 handled that particularly well. Hindlicke also attempted to discredit media reports that as A2 CEO, she sent $19 million of work the way of her former firm, Bain & Company, like as a consulting firm. She said that, well, this isn't true. Now, the A2 Milk Company chairman, David Hearn, wrote to Hindlicke asking her to immediately correct the material misstatements she had made, and she didn't. See, one of Hindlicke's falsehoods, A2 contends, is that you decided to leave your employment for personal family reasons, but in truth, you were asked by the board to leave and agreed to do so. Personal reasons were then raised by you after the board had communicated that position to you. Look, during her tenure, more than $33 million was spent on consultants, of which 80% of it, that's $26 million, was spent at this Bain company, her previous consulting company. Now, Hindlicke essentially was fired by A2 Milk. She pocketed 1.8 million New Zealand dollars of termination pay, and the company was just happy to just let this go. But Jane has been making an issue out of all of this. Then in 2021, there's been departure of multiple managers, plus the hiring of the new CEO, David Bortolussi, who steps into just this fiery mess. There's been multiple class action lawsuits filed on behalf of the shareholders against A2 Milk for not disclosing enough information. The company issued 4 downgrades to guidance over a short period of time in the last 12 months, and shareholders believe that this was misleading. Now, management denies any wrongdoing, claiming that things were moving fast and they were disclosing information as soon as they could. And I'm okay with this. In the mess, management didn't appear to be dishonest. It was just a lot of mismanagement. And the inventory plus very volatile market conditions, lockdowns, supply chain disruptions, it's all very dynamic. So look, that's tough on management to get guidance right. And another little problem was that there's these short-term incentives were actually given to the executive team, even though 2021 was a devastating year for the business. And this was rightly criticized by their shareholders. But the measures undertaken to correct the business so far appear to be working. We have write-downs of inventory have got the inventory issues all under control. The brand appears to have not been damaged, and the balance sheet is still very strong, which I'll get to in a moment. Now, it's definitely still early days for David Bortolussi as the CEO and has walked into this hot, steaming pile of you-know-what. He has a very interesting challenge in front of him, but the one good thing in all of this is that the chairman, David Hearn, has been a constant throughout all of this and appears to come across as a pretty calm and smart guy. Now, regarding the balance sheet, it is in a really strong position with about $650 million in net cash in relation to its market cap of $3.5 billion. That is plenty of cash that the new CEO has earmarked for expansion, brand building, and possible acquisitions. There aren't any plans for a dividend, which I think is fine considering they need to get back to growth. Now, a business with a strong net cash position like this, with almost zero debt, it is really hard for it to go out of business. They would really have to try to go bankrupt. So it gives the shareholders a lot of comfort that this isn't going to zero anytime soon. But remember from the previous episodes, I do think the business as a whole is fragile because it's a perishable food product. Imagine a health scare in milk in New Zealand. That could easily throw all these upcoming valuations that I'm about to do, well, it could throw it all out the window. So for me, it doesn't make this a no-brainer investment. And I'm going to attempt to value the business. The first thing I have to try to get my head around is whether the business is going to improve from here. And I think in the short term, it has a pretty good chance. They have fixed the inventory issues. I think they have bottomed out in terms of sales, as the most recent earnings report suggests that they are turning the corner. So maybe 10% growth in line with the management expectations. I think this is pretty reasonable. The 30% growth levels we had seen prior to the pandemic would be nice, but management don't think that is likely. Therefore, if that happens, that's just a bonus. Now, I also only want to look at about 5 years initially, as I think things just get very unclear after that. And I'm also going to work on 2019 numbers as a valuation, and I think they can get back to this level. Revenue actually is about the same as 2019 right now, so I'm happy to go with that. So my first valuation here is what I've done is I've got the current revenue, which is about 1.3 billion, and I have grown that out at 10% per year for the next 5 years. I've also given them a estimated earnings, I guess, after tax number. So it's 18% of that revenue is roughly what their earnings were. And that's around about what it was back in 2019. So actually 2021 and 2020, this was not the case. It's more like 0% because they're pretty much not making any profit whatsoever. So I'm just going to assume it's going to get back to 2019 levels here. So that's quite an assumption that I'm making. So just remember that. It says here free cash flow 5-year target. It's actually meant to be 5-year target earnings. So just ignore those words there. Then I'm going to put a fair future multiple on that of 15, considering the growth rate's about 10%. I think 15 is about fair. That gives me a market cap in the future of 5.6 billion. There's a little bit of dilution going on, so I'll include that. I've got the shares outstanding number in there, and I've got the current market cap, and we have a 5-year compound annual growth rate of around about 8%. Now I looked at a more optimistic scenario where I've got 20% growth rates and with 20% growth rates, a better PE multiple of 20 as well. So that gives me now a 5-year compound annual growth rate of 25% per annum and a target share price in 5 years of about $14.50. So that's a 3x from here in those 5 years. So that's pretty strong. I would say this is the optimistic scenario. Management did say that 10% is what they're expecting. So look, I would put this more on the unlikely side of things, but remember, this business was growing at like 30-40% prior to the pandemic. Now I've also done a very pessimistic scenario here where I've got 0% growth rates for the next 5 years. We're looking at a loss if the business is not growing whatsoever and just maintaining their current levels. And my fourth and final valuation is I've actually changed the market cap to an enterprise value. So that's taking out the Synlait, Natura Valley Milk, and the net cash position that they have. And we're looking at those 10% growth rates. I would say this is a fair valuation of the business, and we're looking at a 5-year compound annual growth rate of 16%. So if you think management can turn this around, then it's a good investment. And if you are wanting to invest, Interactive Brokers, the link's in the description below for those looking at a better, safer brokerage account. So obviously the most important part of the research is the taste test. So I have regular milk here and I have A2 milk here, and I'm going to see if I can taste the difference. All right. Okay, regular milk. Yeah, I don't notice a difference at all. That's exactly the same in my eyes. So, all right, I guess that's what babies would taste. Let me just try that again. Yeah, I would say nearly identical. So it's a good replacement at twice the price. I guess I have no idea if the A2 milk would be better for my stomach or not, but I'm fine with regular milk anyway, so I'm probably not a good person to test it on. Now, don't forget to give this a like and subscribe. I hope you got something out of these videos on A2 milk, and I will see you in the next video.